We're ready.
Okay, so I'm also ready. So, you see there's the second part, and I changed the subtitle. This morning it was just the introduction. Now it's called New Variations of an Old Theme. Well, it's a bit pathetic, to be honest. Let me just recall a little stuff from this morning's session. So this morning we had the problem of maximizing the expected utility from final wealth, right, over all strategies, and I leave out consumption for the moment, that were admissible. And what we also had, we had the equation for the wealth, the wealth equation, dx pi over t divided by x pi over t. This is just r plus pi of t transpose b minus r multiplied with the 1 vector dt. I don't have consumption here at the moment, plus pi transposed sigma dwt. So, and then we learned there are two possibilities to get the optimal solution. One was the solution by the martingale approach. And the solution by the martingale approach was, well, if I is the inverse of the derivative of u, then I have that the optimal final wealth is b star. That is, I simply take I, and then I had h of t, which was this random discount factor, and then there was a constant y of x. That was the explicit solution for the final wealth, and for the example, u of x being equal to the logarithm, if I have this, then I have the optimal portfolio process, which was sigma sigma transposed, the inverse of that, times b minus r, again multiplied with this vector with 1. So a very explicit result on that side. On the side of the Hamilton-Jacobi-Bellman equation, we had this problem. The corresponding HJB equation was to find the maximum over all pi, and I write down the equation. And to practice this again, what we did this morning, take those terms that correspond to the dw, and you have to take the x to that, and you have a 1/2 x squared, and then to square that it is pi transposed sigma, sigma transposed pi, and this has to be multiplied with the value function, which was the function that tells you how the optimal utility evolves over time and state space. Multiply this with the second derivative with respect to x of that. Then take this term, which is in the dt, which is the multiplier of the dt, which is plus x, and then you've got an r plus pi transpose b minus r, and forgot the 1 here, multiplied with the first derivative, and then there's a time derivative. This should be equal to 0, and the boundary condition that this is equal just to the utility at the boundary condition. So this was the HJB equation approach this morning. So HJB equation approach. So we had this then, and then from this I solved the problem that I had, if I have u of x being equal to 1 over gamma, x to the power gamma, with gamma smaller than 1. And then I showed you that by solving the HJB equation, And now I do it in dimension 1. I arrived at pi star of t is equal to, well, again, b minus r divided by sigma squared, but there is this multiplying factor 1 over 1 minus gamma. Now, these are just things to keep you in mind what the optimal strategies are. And here there is one thing which is interesting. First of all, if you take gamma equal to 0, you get the optimal strategy in the logarithmic case. And the second thing, which is quite interesting, is if you let gamma go to minus infinity, then this thing converges to 0. So if you want to be really risk averse as an investor, then your gamma should be negative, and the gamma like minus 5 or minus 10 or something like that is not unusual. So in a lot of papers you see the assumption gamma smaller than 1 and gamma bigger than 0. That excludes, of course, all those very risk-averse investors. Okay, I think that sums up this morning session, more or less. And now we can go on with what we try to do there. Oh, automatic log off in process. Oops. Okay. So it's maybe a reminder, don't talk too much, do some action. So here are some things that I would like to talk about. Well, the theory we learned so far is quite nice. And you see, you've got very easy strategies, but I already told you, constant in fractions means you have to trade at each time instant. So that is something. If you have transaction costs, they will really eat up all your profits, and you might, in theory, be ruined immediately. Now, problems with transaction costs, typically fixed transaction costs per transaction you have to pay, well, 50 pence or whatever, and you have maybe to pay something which is proportionate to the transacted volume. This makes problems very, very hard to solve. And if you look in the literature, there are not a lot of papers which contain explicit solutions, or which are understandable at least. So the main problem with transaction costs is that there is a kind of curse of dimensionality. Why that? Well, here the problem is essentially one-dimensional. Why that? Well, look at the HJB equation. X is the variable, and X is a number. It's one-dimensional. It's your wealth that is sufficient to tell you how well you should feel at the moment, because you can switch from one asset to another in infinite velocity without paying anything. Yeah? Your wealth summarizes your whole state. If you have transaction costs, your wealth tells something about how well you feel. But of course, if you have all your wealth invested, say, in credit derivatives or things like that, then you should transform immediately at the moment, right? While if you have them invested in good assets, you don't need to transact. So you have to take care of every single holding that you have. Which means, over there, if you invest in 100 different assets, don't care about it. If you have the sigma at hand, if you have the R and the B, things are fine. Computations are easy. But with transaction costs, if you have 100 different investments, you really have to follow those 100 different positions, how they evolve, and then you have to decide about, should I do a rebalancing or not? So that's one thing which is quite hard to think about. The next thing is, we had those constant interest rate stuff here, and of course in real life interest rates are constant but only over short periods. If you want to invest in 10-year bonds or things like that, like insurance companies do, you need an interest rate model. So you should have stochastic interest rate. You got additional interest rate risk, and this also makes problems at least two-dimensional. Another thing is, if you invest in assets, in shares, they are often not liquidly traded. So if you could invest in derivatives on the shares, it's much easier. They are much more liquid. You have a leverage effect and other things like that. You have a nonlinear payoff in terms of the underlying. So investment with derivatives is something which is worth considering and which will be the next point we look at. Investment with defaultable securities was maybe worth looking at the moment. It's a bit, well, in a crisis to have as defaultable securities typically defaultable credits that you could invest in. And then another thing is, what happens if you have the feeling that there is a crash possibility? How should you invest there? So I'm trying to treat nearly all those aspects. And as I said, I might leave out this with the stochastic interest rate. Okay, so let's see. Optimal investment with derivatives. Now, the motivation for that, what I had was, there is a kind of change of role in option trading, and that was some years ago, because options were originally introduced for hedging purposes. Yeah, they should guarantee you a lower price bound or an upper price bound, depending on if you want to have a call or a put or whatever. And what traders are typically doing, traders are selling their options, and then they look at the so-called creeks. The creeks are the partial derivatives of the option prices with respect to certain influences like the volatility, the stock price, the time, the interest rate, and so on. And they always try to have a portfolio that is neutral with respect to a change in the underlying asset, to a change in the volatility, to a change in the interest rate. And why do they want to have that? Well, on one hand, that says, well, if I have a neutral portfolio and my model is just wrong, it's not totally wrong, then this doesn't affect it so much. Or if the stock prices only change slightly, then more or less the value of my whole portfolio stays the same. So they want to be in such a well-balanced situation. And how are they doing that? Well, they have sold some shares, some options, then they calculate the delta, the gamma, the vega, or whatever, and then they see that there are some typical products that they have to buy or sell in addition to get a delta neutral position. It's just a linear equation system. That's easy to solve. But if you nowadays buy options for speculative reasons, like saying have leverage effect, they are more liquid, and so on, control of the creeks or having them neutral makes no sense. Yeah, having them neutral means your portfolio will not change in wealth. So actually, this is the opposite that you want to have. And if you want to have the opposite, then the question is, well, why don't you do the same as with the portfolio optimization when the underlying or when the assets you are investing in are the shares? Well, if you maximize now the expected utility of terminal wealth if you have an option portfolio, the only thing that changes is here, it's not the stock itself at position I, it's an option, and I assume for the moment that the price of this option can be written as a function of time and of the underlyings where the option is written on. Typical example is if it's a call option on stock number I can always be written as the function of t and the price of that stock, as long as there is no such influence as stochastic volatility or others like that. So for the moment, we simply assume that. Okay, so the question then is how to solve this. Yeah, our goal, the goal really is the determination of optimal option portfolios here. And before I give you the result, I draw 2 or 3 pictures that might give you an idea how to do that. Okay, so here's my first ingredient. My first ingredient is option pricing via the so-called replication approach. Now, if you have an option that pays you B in the end, this is the final payoff of the option, then you're actually interested in having the price of the option, right? So, what to write the price? Well, PB, that's the option price. What is the option price? How do you do that? It's time t equals 0. Well, how do you do that in the replication approach? Now, first of all, what we're looking at, we're finding a portfolio strategy, pi, let's say pi b, such that this here, the final wealth of that strategy, equals the payoff, then we go back and we see that initially we need a wealth of X, and of course then we go up there here, because if we can replicate, if we have a replication portfolio, then the initial wealth needed for setting this up has to be the price. Yeah? We started here, we replicated that, we looked what we need for replication, this is the price by the arbitrage principle. Okay, now the second picture. The second picture is the martingale approach to portfolio optimization. How does this work? Now the martingale approach works in nearly the other way around. You have an X here. This is your initial wealth. This is given, so here that was given. Now this is given. And what you want to know is, how do I get the optimal? How do I get the optimal final wealth? Now how to do that? Yeah, how to get the B star, which is optimal in the end. No, I'm not satisfied with this. How to get this final optimum, X pi star of T. That's not clear. Now how you do that here? Now with this thing, we go down and we compute a B star, which is the optimal final payment. This is the first part. We solve the optimization problem, O. We get the optimal final payment. From that, we get a replicating portfolio, pi star, by solving the problem R. And if we have this, we get this in the end. Okay? So, if we can glue those two pictures together in a certain way, then we're done with the martingale approach for optimal portfolios. Let's now see how we can do that. So, martingale approach. To optimal option portfolios. Okay. Actually, the situation is the same, right? We start here with a small x, and we want to have the optimal final wealth. Now, my optimal final wealth here is written in terms of phi. It's not written in terms of pi. It's in terms of phi. Sorry for moving so fast.
Good fast for me.
The point is, what is the x phi star of t? And now phi star, this is the trading strategy in options. Now the first step, maybe, is exactly the same. At least it's an idea, it's not clear if it's the same. First of all, look at all those final distributions you can generate, B star. Then, from that, you could maybe solve that representation problem and get a pi star. And now instead of the pi star, I'm writing this as a, I think I'm writing this as a psi star, but I don't know, it might be exactly the other way around. But I get a psi star. And this psi star is what? Well, this was a portfolio process. Now this is the corresponding trading strategy. This is the optimal trading strategy in bond and stocks. But I'm not allowed to invest in the stocks. Yeah? So I have to do something. And what I can do now is the following. Here I replicated the option by a portfolio process, or you could also have a phi is bad. You could also have this here, the corresponding trading strategy. So I replicated this payment by that. Now, if I have to replicate the stock by the option, it's just more like inverting this. It's just a 1 over. So what I get here is, from this to there, is try to replicate stock positions or stocks by bond and options. And you arrive at a phi star, and this phi star is what? The phi star is more or less, I just write it like this here, it's more or less the psi star divided by the psi star by this here, by the replication strategy, and then I'm done. Yeah? I'm solving the problem as if I would be able to trade in bond and stocks, and then I'm taking the stock position and transforming it, replicating it by options, and then I'm done. That's the idea behind that. And this explains the following theorem I'm showing you. Actually, I have to show that in this market we get the same final distribution, but of course a totally different, I think it's the other way around. I think, well, maybe I just make a -1 to that. A totally different trading strategy. You see it here in that theorem here. Okay, given that the delta matrix, which is the matrix that contains all the replication strategies of the option, given that this is regular, then the option portfolio problem has the following solution. First of all, the optimal final wealth is exactly the same as in the problem where I can invest into stocks. This is really disappointing, right? Because I told you about leverage effect and all these strange things. But on the other hand, why should it be different? We are maximizing the expected utility from final wealth. Given that we are in a complete market, we know that how we get there doesn't matter. We know it's the final distribution that counts. So if this matrix here is regular, the randomness that is in the market, in the stock market, is totally preserved by changing to the options. So the optimal terminal wealth is exactly the same. However, as the underlying assets are not the same, then we see, then we see that it is 1 over, as I said. No, it's not 1 over. The point is that the psi here, this psi is the psi there, and vice versa. Therefore, it's even correct. I was surprised that I did it wrong, but I just switched. I just switched the names of the variables here. So what you see is, if this is the optimal trading strategy in the corresponding stock portfolio problem, then you just have a 1 over with the replication strategy of the options. Otherwise, it's nearly the same. Yeah? You take the stock strategy, you divide by the replication strategy with the options, and then you get this. So again, a completely explicit solution. And here is an example that illustrates that. So, logarithmic utility. What you know is, you know in the logarithmic utility that the pi, the optimal pi, is p minus r divided by sigma squared. So the optimal trading strategy, which is phi 1 times p1, is equal to pi times x. So the optimal trading strategy in the stock market would just be this. But we're now in the option market, therefore we have to divide by the replication strategy. by the stock part of the replication strategy for the option. So this is the optimal trading strategy if I have just one stock and just one option. Now, the question is this bigger or smaller? Is the amount of money invested in the risky asset bigger or smaller if I'm going for an option or if I'm going for the stock on it? Therefore, I've computed the optimal option portfolio process, which is amount of money in the option divided by the wealth process. Now, what we know is the following. We know what the phi 1 of t is. It's b minus r over sigma squared. There's an x here, there's an x there. The x's cancel out. We have the phi here, and we know what this is. This is the so-called delta, the hedging strategy, which is given as the delta, the partial derivative with respect to the price, multiplied with p1 of t. Now, what can be said is, first of all, we don't know if this is bigger or smaller than 1. That depends on the option, on the type of option. Otherwise, the computational effort is the same as in the stock portfolio problem. Why this? Now, the option price is there anyway, and every trader has computed the delta anyway. There is no additional effort. That is exactly the same. And if we look at a particular example here, I used a European call option. Now with a European call option, you know that the price, Black-Scholes formula, is delta times the price minus k times something. So this is bigger than the price, which is this here. So this thing in total is smaller than 1. And actually you see it here. I have this European call, and I have a moderate volatility, the B of 5%. And what you see here is I started at time t equals 0, and I started to calculate the optimal strategy as a function of the initial. It's P1 of 0 should be here, of the initial price of the stock. Now if the call is exactly at the money, so if we have 100 here, then you see the optimal fraction is about 15%, while the optimal fraction in the stock problem would be 80%. Yeah? It's enough to have 15% in the riskless asset, while in the linear market, when you invest in the stock, you need 80%. So this clearly demonstrates this leverage effect that you have. The option has much more potential to generate return. And what you see is if the P1 of t goes to the right, then the option more or less is nothing else than just a linear combination of the stock and minus k in the end, because you know it will end up in the money, and then it increases to there. Of course, if it goes down like this, it goes down to 0, but options which are so much in the money, out of the money, sorry, which are so much out of the money calls, they are not traded anyway. Yeah? And of course, if you're too much out of the money, you should take care about the strike, the smile effect, which I don't do here in the Black-Scholes model either. But what you see is, what you really see is, the option is more risky, the option is non-linear, and therefore it has a higher potential to generate increases or decreases, and therefore you're going for a smaller fraction of investment into the risky asset. Actually, the wealth process is exactly the same at every time instant. Yeah? That's important. Okay, so we can invest into derivatives, and you can calculate whatever derivative investment you would like to, as long as all the assumptions are satisfied. You can even use a digital, which has this point of 0 of the derivative. Yeah? But then, if you take the 1 over, you really get a pole inside. That's quite interesting. But that is something that you can read in the corresponding paper. Next thing, optimal investment with defaultable securities. Now, defaultable securities are, of course, defaultable bonds or shares by companies. And it's clear, usually we're saying in our model, everything that we invest, we get it back if we invest it to a bond. Now here, if we invest it into a company, we might get it back or not. And that depends on if the company defaults or not. And therefore, what I want to do is I want to set up an investment problem that is pretty much similar to the one I considered here. And the good framework for this is the Morton model for defaultable bonds. So how does this look like? Merton model, sorry. Merton's model is the following. Merton says, well, I think that the firm's value follows geometric Brownian motion. Not the corresponding share price, it's the value of the firm. And this company has issued one share and one zero coupon bond with a notional B. Okay, now let's have a look at it. At time t, what's the value of the shares or of the bond? Now it's quite easy what happens at time t. At time t, if the value of the firm is bigger or equal than B, well, what will happen then? If the value of the firm is bigger and equal than B, then everything will be paid back. So B goes to the bondholders. The bond is paid back, that's it. And VT minus B, that of course remains with the shareholders. Yeah? That's the value of the company then, because the B has to be paid out. So what happens if V of t is smaller than B? Well, if V of t is smaller than B, the B cannot be paid back. So the bondholders take over the company. So the whole company goes over to the bondholders and nothing remains for the shareholders. Okay, so in total this means at time t, the value of the asset St is what? You saw it. If V is bigger than B, then this is Vt minus B. If Vt is smaller than B, then it's 0. So it's just this. And how about the bond at time t? Well, if V of t is bigger, then it's just B. If V of t is smaller, then it's V of t. So this is this. So you see, the value of the bond at that time is the face value minus the value of a put option on the firm value with a strike of B. The value of the share at that time is, or the payoff of the share at that time is just a call option with a strike of B. Now, you see here what the reason is why Merton assumed that the firm value follows geometric Brownian motion. Because he knew that he has the Black-Scholes formula at hand, right? So with this assumption that you have here, with this here, and with the idea that at time t the value of the share is given as a call, the value of the bond is given as the difference of the face value and the put option on that, that's here, and the Black-Scholes formula at hand, you know exactly that these are the prices. This is the corporate bond price. Yeah, it has a plus here instead of the minus that you know from the usual put option. It has the plus here because there is this minus and there is this one here. So this is the price for the corporate bond at the times before. Okay, that's the corporate bond price. So the question now is, what we are going to do is we're trying to put up an optimal investment problem if we invest in the corporate bond and if we invest in a government bond. And we now know that the corporate bond is more or less nothing else than an option. And we have just solved the optimal investment problem for options. So what we're doing then is we're starting with the investment problem as if we could invest into the firm value here, and if we could invest into a usual bank account or government bond. We solve this problem first, and then in the second step we solve the portfolio problem with options, and then we arrive at this. Yeah, it's exactly the same problem as before. I left out saying we solve the problem as if the firm value would be tradable. We have solved that, and then we arrive at those things, a minus r over sigma squared, or a minus r over sigma squared 1 minus gamma. These are the optimal solutions in the case where the firm value would be tradable, it is not, of course, the firm value is not tradable, but then we say we have solved this, and now we replicate the positions in the firm value by the positions in the defaultable bond, and so we get this here. Okay, now have a look at this. What can we say about that? Now this time, remember the price of the defaultable bond. Here, the price of the defaultable bond is bigger than that. So this time, it's a bit difficult. This time, we're really leveraging on that. We're investing more in the defaultable bond than we would have if we would have invested in the firm value. Okay, again, the optimal final wealth is the same, but the invested money in the company's bond, this really exceeds the one as if we would be investing in the firm value. So we have a more risky investment there, and that's it. Again, here you can now try to come up with more sophisticated models for the defaultable bond. The Merton model is the most simple one. You can only get default at the end, not in between, right? You have a geometric Brownian motion for the firm value. That's also questionable. However, if you use more sophisticated models, like there is a model by Black and Cox that says we already know that if the firm value goes down below the discounted value of the face value at the end, there is already a bankruptcy or default before that time, then you have the same, but then your option is not a call option or a put option, then it's a down and out call option or a down and out put option. So the formulas get more complicated for the replication strategy, otherwise it stays the same. Or you could use a model by Priy and de Varenne, where you have a stochastic interest rate instead of a constant interest rate. You can still solve this. So there is this paper by Holger Kraft and myself where all those cases are considered. Okay, so we have now solved the optimal problem for investment in derivatives. We have solved the optimal investment problem if we have defaultable bonds.
So one more question, just because it interests me. If instead of the defaultable bond you would include the share price derived by Merton's approach in that setup, and you would consider the optimal investment problem, what would that imply? Because you also, if you have the share price exogenously given by the geometric Brownian motion, how would these two set up?
That's a good point. Good, yeah. If we look at this, the good point of this question is that usually we're saying we're looking at the share price as a geometric Brownian motion, right? So we're saying S of t is, well, yeah, here we have the following. We have S of t is V of t times phi of, and then there is the logarithm of phi of t of k plus r plus 1/2 sigma squared t minus t over sigma t minus t, and the k of course is a b, minus b e to the minus r times t minus t, and then we have exactly the same, but we have a minus sign in front of the 1/2 sigma squared. Otherwise it's all the same. Now the question is this the stock price, or is the stock price the geometric Brownian motion, right? And the point is, if you let your b go to 0, for b going to 0, what happens? Now this thing here goes to 0 anyway, as this is bounded by 1. This thing here goes to plus infinity, as vt is positive. So this goes to phi of plus infinity, and what comes out is just this. So if the company has not issued any shares, you're again in the geometric Brownian motion model.
You mean bonds? If the company...
no bonds, sorry. If it hasn't issued any kind of bonds, you're again in the geometric Brownian motion model. So this is consistent, those two things. And as I said, it's a really good question, because otherwise it looks like, well, if it's convenient for us to work with stocks, we say this is geometric Brownian motion. On the other hand, we say the firm value is geometric Brownian motion. And of course, if it has not issued any bonds, then the firm value and the price should be the same, and it is like that. It's really consistent. Okay. I have used, or I've decided to use the strategy to invest into the defaultable bond. You could also invest into the defaultable share here, but then you get the same result as I had on the previous problem when the optimal investment with the call was there. And again, here you can fiddle around with a lot of other kind of models and try to do a bit. That's quite instructive to do. Okay. So 2 of our problems are already dealt with. It would be a natural point to make the break here.
It's fun.
Okay. So then just make the break.
If I can want to.